Okay, so uh, even for those of us who, diligently follow the financial markets, it's still easy to get lost sometimes. Just the sheer volume of information
Right.
and all the nuanced choices.
Absolutely. It can feel overwhelming.
So today, we're taking a deep dive into Vinod Pottayil's What Every Indian Should Know Before Investing. That's a remarkable resource, I think. Promises to refine even experienced investors' foundations, maybe unearth some hidden wisdom.
Yeah, that clarity is exactly what we need. And it really frames our whole deep dive today, doesn't it? Our
Yeah.
mission really is to distill the most impactful insights from this guide, moving beyond just like definitions to the why and the how of building financial confidence.
Right.
Think of it as maybe a personalized shortcut,
Yeah.
a deeper understanding of the whole financial landscape.
Absolutely. From the fascinating psychology behind why we spend to the nitty-gritty of different investment vehicles, we're here to help you understand not just what to do, but why it actually matters.
Yeah, and how to apply it.
And how to apply this knowledge to your own life. We've got some pretty fascinating points coming up that might just shift your perspective a bit
Hmm.
on how you approach your finances.
Good.
So Potiel starts right at the gate with this really relatable anecdote. A mother taking her children's prize money, right? Promising something nice and valuable later.
I remember reading that part.
Yeah, initially, the kids are baffled, upset even, but months later, boom, a brand new music system appears, purchased with their saved money. That mother and children story really nails it. I think we've all been those kids, haven't we? Wanting that prize money now.
Oh, definitely. It's a primal urge to overcome, isn't it?
It is.
And what's truly insightful there is that investing, it fundamentally challenges our most basic human nature, that instant gratification impulse.
Right. Spend it now.
Exactly. It forces us to delay pleasure, to make a conscious choice for, a greater future reward. The example vividly illustrates that core mental hurdle. It shows us that the first investment you make is often in yourself, developing that discipline.
That makes sense. And the key to overcoming that hurdle, according to the author, clear goals.
Mm-hmm.
If you can actually see that finishing line, you're far more motivated to be a disciplined investor. But, okay, even with clear goals, the sheer volume of choices, all the conflicting advice, it can be paralyzing.
It really can.
So how does the book suggest we actually, cut through that noise and choose wisely?
Well, the book emphasizes that while not everyone can or even needs to become a full-time financial expert, acquiring basic fundamental knowledge is just crucial.
Okay.
It's about empowering you to question, probe, analyze, making informed decisions rather than just being swayed by, attractive numbers or some fleeting tip someone gave you.
Like Warren Buffett said.
Exactly. It's what Warren Buffett hinted at when he famously said, rule number 1, never lose money. Rule number 2, don't forget rule number 1. That knowledge, it acts as your primary defense.
Okay, so from understanding our own financial psychology, the book then takes this really insightful detour. It challenges a deeply ingrained stereotype about who makes a savvy investor. Let's delve into the surprising truths it reveals in the chapter on women and investing.
Yeah, this is a really powerful section. Conventional wisdom, often misjudges women's financial acumen, implying they don't understand numbers or manage money well. It's just wrong.
Completely wrong.
But the book powerfully demonstrates that women not only dedicate significantly more time to researching investments, but their inherent tendencies towards lower risk, meticulous planning, that sort of nurturing long-term perspective.
Like raising a child or caring for a plant. right?
Exactly. That directly translates into a more stable and ultimately often a more profitable investment approach. It's a powerful combination of diligence and patience.
It's a complete shift in perception, isn't it? Highlighting strengths that are often just overlooked in the financial world. So what are the practical implications here for you, the listener?
Well, in our changing social dynamics, a woman's active role in investing can literally be the difference between a financially secure family and one that struggles.
Wow.
The book really urges women to just start, even with small amounts, simple options like a recurring deposit. Because a habit, that's more important than the initial sum. Just get started.
And the book points out there can be tangible policy advantages too, right, for
Yeah.
women investors in different regions, like reduced stamp duties on home purchases or discounted home loan rates.
That's right. And these aren't just minor perks. They can translate into really significant financial savings. It demonstrates a powerful incentive for women to get engaged in investing.
Little money.
Exactly.
Yeah.
And critically, women's involvement can also moderate sort of potentially disproportionate risks men might sometimes take, safeguarding the overall family well-being.
A balancing act.
Precisely. And as mothers, becoming a knowledgeable investor also equips them to impart essential money habits to their children. So that's a truly invaluable gift, isn't it? Something that compounds across generations.
Absolutely. Okay, so we've tackled the crucial mindset shifts, some surprising insights into who makes a great investor. But, with the right mindset, you still need the right language to navigate this world.
The jargon.
The book gives us that essential vocabulary, doesn't it? Let's maybe start with assets.
Indeed. So assets are broadly categorized into debt, think, fixed deposits, PPF, then equity company shares, equity mutual funds,
Yeah.
real estate land, homes, and commodities, gold, silver, that kind of thing.
Got it.
Each has different characteristics. And the book's insight is that understanding these categories helps us evaluate any investment based on 4 key factors: liquidity, safety, returns, and tax savings.
Right. Liquidity. We all kind of get what that means,
Yeah.
how quickly you can turn an asset into cash without losing its true value. But the book sort of challenges us to think about the cost of illiquidity, doesn't it?
It does.
What does it truly mean for your financial planning if your wealth is tied up in assets you can't access quickly when you need it?
And then there's inflation, that silent wealth eater.
Always lurking.
It's often mentioned, sure, but the book pushes us to actually quantify its true impact. If your money isn't growing faster than inflation, you're actually losing purchasing power. You might have more rupees, yeah, but they'll buy you less stuff.
That's a scary thought. Another fundamental concept. Capital gains the profit you make from selling an asset. The book clarifies it's not just the simple difference between buying and selling price.
No, there are costs involved.
Exactly. If you bought shares for, say, $5,000 and sold for $6,000 but paid $55 in brokerage fees, your actual capital gain is only $945.
Right.
And that profit is subject to capital gains tax, which varies based on how long you held the asset. It's a detail that can really impact your actual take-home returns.
This attention to detail is vital. The book also explains dividends payments from company profits to shareholders, and it highlights a critical historical point. That old confusion where dividends were announced as a percentage of face value, not the current market price.
Oh, yeah, that was confusing.
Very. So SEBI, the Securities and Exchange Board of India, stepped in to mandate declarations on a per-share basis, made it much clearer for investors to grasp the real value they were getting.
That transparency is so important. And for truly effective investing, the book stresses understanding your investment objectives.
Yes. Why are you investing?
Right. If your child's education needs, say, $5 lakh in 10 years, you'll choose options differently than if you were saving for a down payment next year. This is where the book introduces these powerful formulas.
If future value, present value.
Exactly. Calculating the future value of your investment or the present value needed today to reach a future goal, and explains them with clear, practical examples, which is really helpful.
It makes it less abstract.
Totally. Okay, so with that foundational understanding of key terms under our belt, the book then guides us through the practical landscape, investment options, moving from the most conservative to those with higher potential and, well, higher risk.
Right.
Let's start on the safer side, maybe. Fixed deposits, FDs.
Okay, so the book presents FDs not just as simple investments, but almost as a psychological anchor for some people.
Interesting.
But the real insight here is understanding their limitation. While they're safe, predictable interest, they often struggle to actually outpace inflation.
So you're losing buying power.
Potentially, yes. Meaning their true power is more about capital preservation for specific short-term goals rather than real long-term wealth growth. That safety comes with an opportunity cost, you see.
Makes sense.
You can choose cumulative FDs, they pay interest at the end, or you can opt for regular payouts, though that usually means slightly lower overall returns. And tax-saving FDs, the ones with a 5-year lock-in, offer Section 80C benefits, but no loan facility. Locked in.
Okay, and that safety net you mentioned earlier, the DICGC guarantee up to $1 lakh. Does the book offer any clever strategies for listeners to maybe maximize that protection? Structuring accounts differently or something?
It does, yeah. It reminds us deposits up to $1 lakh per person, per bank, are guaranteed by the DICGC. A clever strategy, it suggests, is holding joint accounts but with the names in different orders.
Oh, interesting.
Or, more simply, just spreading your deposits across multiple banks. It's a smart way to ensure broader protection for your capital if you have more than the limit.
Good tip. Shifting along the risks spectrum now, the book delves into government-backed schemes, things like the Post Office Monthly Income Scheme, POANS, and the Senior Citizens Savings Scheme, SCFS.
Right, offering assured income for specific groups.
And then PPF and EPF Public Provident Fund, Employees Provident Fund, highlighted as excellent secure options, especially for their tax-free returns after you hold them long enough.
Very solid long-term options.
But then there are stocks, the
Right.
investment option that, evokes really strong reactions.
Ah, yes, definitely.
Stocks often carry this reputation, right? High risk, high reward, fortunes made and lost. The book offers a crucial perspective on approaching them, doesn't it? What's the fundamental understanding it wants you, the listener, to grasp before diving in?
Well, fundamentally, stocks represent fractional ownership in a company. Simple as that. Your gains come from dividends, if they pay them, or selling at a higher price.
Okay.
The book clearly outlines how just myriad factors, company profits, analyst forecasts, management changes, technology shifts, interest rates, exchange rates, even just market sentiment. The famous bulls and bears cause prices to fluctuate wildly sometimes.
Right.
So the core message is direct stock investing requires significant due diligence. You need to research companies and sectors you genuinely understand and invest in a manageable number of stocks you can actually keep an eye on. It's about being an owner, not a gambler.
That's a key distinction because this is where many beginners get tripped up, right? Chasing those hot tips.
Oh, absolutely. Very dangerous.
That's why the book points many towards mutual funds as a way to invest indirectly in the stock market, with professional management handling the research.
Exactly. Mutual funds pool money from lots of investors, investing in a diversified way to average out the risks. The net asset value, or NAV, it fluctuates less dramatically than individual stocks because of that diversification.
Makes sense.
But the book highlights a really critical distinction: direct versus regular mutual fund plans.
Yes, the expense ratios.
Precisely. That seemingly small difference in expense ratios, often just 1% or even less, it might look negligible at first glance, but it compounds dramatically over time.
How much difference can it make?
It can lead to significantly higher returns in direct plans simply because you avoid paying commission costs year after year. This small difference can mean thousands, even lakhs, over the long term. It's huge.
Wow. Okay. And for disciplined investing, especially mutual funds, the systematic investment plan, the SIP, that's often called a game changer.
It really is.
The true genius of SIPs, as the book powerfully demonstrates, isn't just the math of rupee cost averaging, although that's clever. It's how it neutralizes our biggest enemy. Ourselves, exactly. It's like a behavioral hack. It forces discipline and eliminates that crippling anxiety of trying to time the market. Makes consistent long-term wealth accumulation almost inevitable, or at least much more likely, for the average investor.
Yeah, the book illustrates this with a really compelling example. An investor putting in, say, $2,000 monthly via SIP over 10 months could end up with a gain of $3,563 versus potentially a lower gain if they'd put it all in as a lump sum.
Why is that?
Primarily because the SIP allowed them to buy more units when prices dipped during those months. You automatically buy more when it's cheap, less when it's expensive. SIPs work best over longer horizons, maybe 3 to 5 years or more, and they just remove that emotional when should I buy dilemma entirely.
Takes the stress out. Okay, finally, let's briefly touch on real estate and gold. Real estate involves substantial money. It's illiquid.
It's very illiquid.
And values are affected by demand, supply, interest rates, government policies, all sorts of things. A key takeaway from the book here is the crucial difference in comparing properties by carpet area.
Yes, the actual living space.
Versus built-up or super built-up areas, which can vary wildly and significantly impact the true price per square foot you're paying. It's a common trick, isn't it? To make a property seem cheaper than it actually is.
Absolutely. The book gives a practical example showing how a flat quoted at, say, $1,800 per square foot for built-up area could actually be more expensive than one quoted at $2,000 per square foot. But for carpet area, you have to compare apples to apples.
Good point.
It's also worth noting the concept of a reverse mortgage for senior citizens, allowing them to earn monthly income from their home without selling it. The payment is considered a tax-free loan. It's a creative solution for liquidity in later life, potentially.
Interesting. Okay, let's move to a critical area, often overlooked perhaps. Insurance. The book makes it crystal clear. Life insurance is a necessity if you have financial dependence, period.
Yeah, non-negotiable, really. Its core purpose is simply to ensure your family's financial security if you're no longer around to provide.
How much do you need?
Well, the book suggests using a needs-based method to calculate how much cover you need. Basically, adding up future expenses like children's education, maybe paying off your home loan, for instance, a 20 lakh home loan plus maybe 40 lakh for general family needs means you might need around a 60 lakh cover.
Okay, and here's a crucial piece of advice that really resonated with me from the book. Separate your life insurance from your investments.
Yes, don't mix them.
Pure term plans offer high cover for relatively low premiums and are generally ideal for protection. The logic is, if you lose your job, for example, you might need to stop your investments, but you absolutely don't want to jeopardize your essential life cover.
Makes perfect sense.
The book also highlights that as per IRDA rules, insurance companies must pay any claim made 3 years after a policy starts, for any reason whatsoever. That's an important protection for policyholders.
Good to know. And health insurance is equally vital. A World Health Organization study, cited in the book, is shocking. It reveals almost 40% of Indian families fall into debt because of health expenses.
Wow, 40%.
And 16% slip below the poverty line, with, cancer diagnostics costing significant amounts, chemotherapy sessions running into tens of thousands per cycle. Medical bills can be just catastrophic.
Devastating.
A health insurance cover is your best defense against having all your hard-earned investments wiped out by one medical emergency.
Absolutely essential. Whether it's an individual policy or a family floater, which, while cheaper, can sometimes be exhausted by multiple claims in a year, it's about protection.
Right.
And if you have employer health insurance, great. But remember, it stops the moment you leave that job.
That's a crucial point many forget.
So having a personal backup plan, even a smaller one, is a true lifesaver. It safeguards your entire financial future.
The book also does a good job distinguishing between top-up and super top-up health policies. It can be a bit confusing.
How do they differ?
So a basic top-up policy applies its threshold, its deductible, per individual hospitalization, whereas a super top-up applies that threshold to the sum of all hospitalizations in a policy year.
Okay, give me an example.
Right, so say you have a 5 lakh threshold. If you have 2 hospital bills in a year, one for 3 lakh and another for 4 lakh, a simple top-up pays nothing because neither single claim crossed the 5 lakh threshold.
Wow.
But a super top-up policy would pay 2 lakh because the total claims, 3 lakh plus 4 lakh, euro 7 lakh, exceeded the 5 lakh threshold. So it covers the amount above the threshold.
That makes a big difference.
It really can. And don't forget things like critical illness policies. They pay a lump sum on diagnosis, and hospital cash plans, which offer daily payouts while you're hospitalized. They serve different purposes.
Lots to consider. Finally, to truly seal your financial plan, you need a will. It's often neglected, isn't it?
Sadly, yes. Very often.
But it's the only way to ensure your assets are distributed exactly as you wish after you're gone. Otherwise, you die intestate, and the law decides, which can get incredibly complex and messy.
Oh, the complexities of inheritance laws, especially when someone dies without a will, are just significant. Globally, really. The book uses examples from Indian law, like how a childless Hindu widow's self-acquired assets might be distributed differently than assets she inherited from her parents.
Wow, that's specific.
Yes, just to underscore the critical importance of having a clear, legally sound will. And remember, a nominee in your bank account or investment, they're merely a caretaker, legally speaking, not the ultimate owner. Your will dictates true ownership.
That's a common misconception.
It is. So the simple advice is, write a clear, dated will. Identify your beneficiaries precisely, and crucially, inform your executors where to find it. The book also touches on things like privileged wills for soldiers in exceptional circumstances. A fascinating historical detail, actually.
Okay, so if we pull all these threads together now, the ultimate goal, as the book outlines, is really to create your own personal investment plan, your roadmap to financial freedom.
Exactly. And it starts with understanding your current financial situation. Calculating your net worth, that's your assets, minus your liabilities, and your savings potential, your income, minus your expenses.
Getting honest about the numbers.
Yes. And this isn't just about big numbers. It's about being truly honest with your money. The book notes many outwardly wealthy individuals actually go bankrupt because lavish lifestyles lead to negative net worth and negative savings potential, regardless of their high income.
Spending more than they have.
Precisely. Then you identify your financial goals. What are they? A new car, higher education for the kids, retirement. Once those are clear, you build a plan using the appropriate investment options and those essential formulas we discussed earlier.
Like the future value calculation.
Right. For instance, that example. If your child's MBBS costs 10 lakh today and education inflation is running at 10%, In 17 years, that same course could cost over Yifilak.
That really shows you the power or the terror of compounding inflation and the need for long-term planning.
Absolutely. That's why proactive planning is so vital and a critical, often overlooked component of any financial plan.
Only guess. Health insurance.
You got it, health insurance. Without it, even the best investment strategy can be completely derailed by unexpected medical expenses.
Right.
A modest premium, maybe 7,000 for a decent 4 lakh family cover can protect your entire financial future. It acts as a crucial foundation for everything else.
So important. And a final thought for you, the listener, to mull over. The book encourages involving your entire family in this financial planning process.
Yes, making it a team effort.
When everyone understands the goals and feels like they're contributing, not only does it increase participation, but it also drastically reduces that impulsive spending, makes the whole journey more successful. It shifts it from feeling like a personal burden to more of a shared mission.
Well said.
So we've journeyed through the essentials of investing today. We've debunked some myths, explored diverse options, and really underscored the importance of comprehensive planning and protection. From, the nuanced power of a simple fixed deposit to the complexities of the stock market and the absolute necessity of having a will and insurance.
Remember, knowledge truly is power in the world of finance.
That's a powerful takeaway. The path to financial security, it isn't about getting rich quick, is it? It's about understanding, planning, and disciplined action over time. By becoming a knowledgeable investor, you're not just securing your own future. You're actually building a legacy for your loved ones, too.
So what stands out to you from today's deep dive? What small, actionable step can you take this week, maybe even today, to begin or refine your own financial journey? Perhaps it's finally calculating your net worth, maybe looking into a direct plan SIP, or just getting that will written. The choice is yours, but the time to start.
Well, it's always now, isn't it? Thank you for joining us.